Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with John Davies of Seneca Partners to talk about the Seneca Growth Capital VCT. Hello, John.
Morning, Alex.
First off, can you just tell me about Seneca and give me a brief introduction to yourself?
Yeah, of course. Seneca was started around 2011, 2012. Three guys based in the Northwest in an office in Haydock. I think fast forward to today, we've grown kind of exponentially to a level where we've got around about just over 800 million under management across multiple disciplines, which I think sets us apart really from others in the market. Included in that amount under management is our growth capital side of the business, where we have about 100 million of VCT and EIS funds that we've raised and deployed. In terms of myself, I've been at Seneca 5.5 years now. More formally, I am ACA qualified. I came through audit, through transaction services, financial due diligence. I've worked in business recovery and more latterly in mergers and acquisitions. So all those skill sets kind of come together to put me in a good place for an investment role. I think in terms of Seneca, we are a differentiator, I think, in the market that we operate with our regional focus, and I mentioned before, a number of different disciplines under one roof, and we like to think that we offer something slightly different to the rest of the market.
And if we talk about the VCT, what's it aim to do for investors? How much is in it? And what sort of companies is it already invested in?
So we've raised to date, we launched just over 2 years ago. We've raised 7.2 million, I think, around to date so far. And in terms of the businesses that we're looking to invest in, we're looking to invest in more established businesses. We're not looking to invest in startups. I know many will say that as well. We prefer to come in around 3, maybe 4, when the business has a proven concept that it's commercialised and it's actually in its growth phase. We're a generalist investor. I think diversification is key, particularly in this area of the market. So we never wanted to pigeonhole ourselves in any one sector. We wanted to be management team led, and if it's a management team that we like, we tend to back them. I think what we offer as well is just that regional exposure that others may not. In terms of the current portfolio, we've actually invested in 10 companies to date. We've fully exited 1, we've partially exited 2 in a very short space of time. We've got 9 companies remaining, and there's a good blend in there at the moment of different sectors, different levels of companies in terms of the stage that they're at, but also, which is a differentiator of ours, is that we've got a nice mix of AIM listed and private companies that brings a further level of diversification for investors.
Okay, and do you want to talk about a few recent investments you've made and why you made them? Yeah,
absolutely. So I was planning on talking about 3 today, and we'll talk about a couple of private ones and and one of our AIM listed investments. The first one is called 1080. Now 1080 is a SaaS platform that enables contractors in different industries, in different sectors, to work remotely and independently. Now, the guys that set 1080 up have a background and have been very successful with SAP, so it was no surprise that their first target market, which is an enormous multi-billion-pound market, was the SAP market. And what they've quickly been able to do is form an alliance and a partnership with SAP for SAP to push them out to their customer base. Now, what the platform enables contractors to do then is, rather than work for the likes of the big consultancy businesses, Accenture and Big Four, who make a lot of money employing contractors to work in different corporates, these contractors now can go direct to the corporate, and the corporate can place jobs directly with the contractors. So contractors can be paid more than they would ordinarily, and corporates can pay less than they would ordinarily. So it's a win-win on both sides. And the key to it again is, in the face of COVID, I mean, this was a good business in its own right anyway, but when COVID actually hit, it became even more apparent that companies need to have contractors working on SAP for this particular example, but globally across all sectors. The platform enables these contractors to do that work remotely. So really in vogue and a really exciting business. The other 2, so the other one I wanted to talk about was Optibaltics PLC, which is one of our AIM quoted investments. It's a life science business on AIM. It's focused on producing technologies that modulate the human microbiome, so the bacteria in your gut. Now, Opti's focus initially, I mean, there's so many things that you can do when you can manipulate and change the microbiome, but what they're focused on initially has been obesity, lowering cholesterol, lowering blood pressure, and also helping with diabetes. And when you think again, in terms of the current pandemic, and just in terms of the market in general, in that market is growing, at a real pace, and it's really again, really in vogue at the moment for companies, particularly food companies, because most of the ingredients that Opti produces goes into food supplements. It's a huge and growing market for them. Opti already has over 50 different contracts signed with global food manufacturing, food supplement manufacturing companies, and also retailers. And it also sells its products direct to consumers as well. So again, a business that's right in the right place at the right time and growing really well. The third one, is an example of a business that was hit by COVID, but because of its operating model has done fantastically since that first hit, and that's Silk Thread, which we've spoken about before. It's an online female fashion marketplace for up-and-coming brands. It has access now to around about 800 different brands. It has over 1 million customers. When COVID initially hit, Silk Thread's revenue dropped off a cliff, understandably, because its revenue was generally generated from, it was event driven, so proms, weddings, nights out, etc. So it dropped right down, but because of the operating model that Silk Thread has, it doesn't hold any stock, it holds minimal stock, and it has 800 brands from which to choose from. All it had to do was pivot what it was selling, and it chose to sell things that women in particular, between the age of say 25 and 35, would want to buy during the COVID pandemic, and day by day those sales levels just increasing. It's now trading at higher levels than it was pre-COVID. So a real success story for us in this new era, and it's a growing market as well because it is e-commerce related rather than bricks and mortar. And I think everybody recognises that's bricks and mortar, whilst it's not dead and it's still going to have a place, it's going to be reducing as the e-commerce players come through.
So continuing with COVID, how has COVID affected your portfolio in general? You've mentioned some successes.
Yep.
Has that been the case all over? Or?
Yeah, so I think when it first hit in February and March, we took we had a full review of every single business, all 9 that we had at the time, and we applied provisions where we felt that there could be a risk of COVID hitting them, and those were mainly aimed at the businesses like Silk Thread that had retail, consumer spend, and retail exposure, and our net asset value at the time took a hit of around about 12%. Since that time, and as at last week when we announced it, our NAV now is back above pre-COVID levels. So we've recovered the provision that we had to put in and some again, and that's due to again the split of AIM and private that we've always had, and what can happen when you've got AIM businesses that are good within your portfolio, and the performance of those has helped to bolster it, and also the performance of Silk Thread. I think out of the 9 investee companies that we now have, I think it's fair to say they're all in really good shape and really good position to do well during and after the COVID pandemic.
And how involved are you getting in these companies?
Yeah, in terms of the AIM listed ones, you can't be involved, you can't be on the boards. We will get involved as much as we can. In terms of the private ones, we generally take board positions. What we've been able to do in the early stages of the VCT is we have our EIS funds as well. So whilst our check sizes were restricted out of the VCT, we've been able to co-invest with our EIS funds and take proper equity stakes in these businesses, get the right controls and the protections for our investors. So, I sit on the board of a number of them, and so do my colleagues.
So at the beginning you mentioned you've already had an exit. Talk me through that.
Yeah, well, it's 3 in all at the moment, 1 full and 2 partial, and they were all AIM quoted businesses, which again shows the the benefit that you can get from AIM, you can quickly turn things around and exit them profitably. But the one that we exited fully was called GeneDrive. And GeneDrive, again, is a life science business, and it provides a molecular diagnostic platform to identify infectious diseases. We've been monitoring the business for probably 4 or 5 years. It's Manchester based, so right on our patch. Earlier this year, it released news that its platform could be or might be used for identifying COVID-19 in terms of an infection, at which point we were offered the opportunity to invest, and we did do. Very quickly following our investment, the share price rose significantly, and we took the opportunity at that point, weighing up the risks, to exit the business in full. Again, just showing what you can do on AIM and what a portfolio of AIM and private can deliver in a relatively short space of time.
So it's doing well to date. Obviously, it's risky, as all VCTs are. Typically, what would you expect as a failure rate?
Well, look, we've only been in. We launched the VCT 2 years ago. We haven't had a failure yet. But I think the true track record we should look at is we've been growth capital investors for 8 or 9 years. So the best thing to look at is our track record over that period of time. And I think if discounting anything that was hit because of COVID, I think you can adjust for those. We have had a failure rate of around about 10% in terms of our investing in growth capital businesses.
Okay. And if I was going to invest in a VCT this year, summarise, why should I invest with you?
Well, what you're going to get from us is a clean VCT. We're an experienced growth capital investor. We've proven that over the years. Since we launched, we've done exactly what we said we were going to do. We've raised money, we've exited fully and partially 3 investments, all profitably. We've paid dividends, and we still have distributable reserves to continue to pay those dividends. And in fact, we'll be looking to increase the dividend target over time as well, whereas others may not. What we don't have are any legacy issues with legacy portfolio companies. I think other more established businesses, whilst they've, the legacy businesses have always formed the bedrock of their in portfolios. I think that's kind of been flipped on its head now for some, because a lot of businesses that are highly leveraged may not be doing as well as they would have done ordinarily because of COVID. What you'll also get with Seneca is just something different from others, different deal flow, regional deal flow. And because we have so many different touch points through that multidisciplinary approach, we get to see deals that potentially others will not. So there's off-market deals there where you get better value. And there's also deals because we have so many different disciplines under one roof, that deals that we could unlock that perhaps others may not be able to.
John Davies of Seneca, thank you very much.
You're welcome.